For decades, the US dollar has been the world's financial anchor. What oil is priced in, the currency that underpins global trade, and the standard for international reserves. It's been the backbone of the world economy, trusted by governments, businesses, and investors everywhere. What global trade runs on, from massive oil shipments to everyday consumer goods, all flowing through a system built on the dollar's strength. But today, October 3rd, 2025, cracks are showing in that foundation. The financial world is watching with growing concern as the dollar's dominance is being questioned like never before. The Federal Reserve is slashing interest rates to revive a sluggish economy, but that makes the dollar less appealing to foreign investors. Lower rates mean less reward for holding dollars, so money starts to look elsewhere for better returns. Meanwhile, China's biggest companies are quietly shifting away from the dollar, raising money in Yuan instead. This move signals growing confidence in their own currency and a desire to reduce reliance on the US dollar. This isn't just a blip, it's a convergence of trends, a nervous Fed, a rising China, and a global system questioning old assumptions. The world is rethinking what it means to trust the dollar. Gold prices are soaring, signaling that investors are losing faith in paper currencies, especially the dollar. When uncertainty rises, people turn to gold as a safe haven, and that's exactly what we're seeing now. Why does this matter? Because a weak dollar means higher prices for imports, phones, cars, even clothes. Everyday items become more expensive, and your paycheck doesn't stretch as far. Your summer vacation abroad, suddenly more expensive. Traveling, studying, or doing business overseas now costs more, putting a strain on families and companies alike. For businesses, it means pricier materials and slower growth. Companies face tough choices: raise prices, cut costs, or risk shrinking profits. The dollar's stability isn't just a Wall Street issue, it's a kitchen table issue. It affects your bills, your savings, and the cost of living in every American household. The signs of trouble are too big to ignore. From news headlines to empty storefronts, the impact is spreading across the economy. The dollar's weakness is about power, trust, and a shifting global landscape. Other countries are stepping up, and the balance of economic influence is changing. The question now: is the dollar's long reign coming to an end? Or can it adapt and remain the world's anchor in a rapidly changing era? The Federal Reserve's main tool for steering the economy is the federal funds rate, a critical lever that influences nearly every aspect of the financial system. This is the interest rate that banks charge each other for overnight loans, and it sets the tone for borrowing costs across the country. By cutting this rate, the Fed aims to jumpstart economic activity, making it cheaper for businesses to invest, expand, and hire, and for consumers to borrow for homes, cars, and education. Right now, the Fed is slashing rates aggressively to combat sluggish growth and prevent a deeper downturn, hoping to encourage spending and investment. However, when US rates drop, global investors often seek higher returns elsewhere, selling off dollars and causing its value to decline on world markets. The Fed is making a calculated bet that stimulating the economy is worth the risk of a weaker dollar, even as it faces tough choices. A falling dollar can boost US exports by making them cheaper abroad, but it also means Americans pay more for imported goods, fueling inflation at home and squeezing household budgets. If the dollar's value drops too quickly, it can trigger panic in financial markets, leading to sharp sell-offs and increased volatility. The Fed is under immense pressure, not just from economic forces, but also from political leaders and the public, all demanding quick solutions. Its independence is being tested, making already difficult decisions even more complex and fraught with risk. The central bank is walking a tightrope, trying to keep the economy afloat while every rate cut adds more pressure to the dollar's decline. The stakes are incredibly high. A single misstep could send shockwaves through the global economy and have severe, lasting consequences. The Fed's gamble is risky, and the entire world is watching closely, waiting to see what happens next. The outcome of these decisions will shape not just the future of the dollar, but the financial well-being of every American family. The Fed's challenge is clear: stimulate growth without triggering a currency crisis or runaway inflation. Can they pull it off, or will the risks outweigh the rewards? Only time will tell. While the Fed struggles to manage inflation and economic uncertainty at home, its influence abroad is being tested like never before. Across the globe, China is quietly and steadily building a new financial order, one that could reshape the balance of power in international markets. For years, Chinese companies and investors relied heavily on the dollar for global business, trade, and fundraising, making the US currency the backbone of international finance. But now, China is pushing its own currency, the yuan, as a credible global alternative, aiming to reduce its dependence on the dollar and increase its own economic influence. This isn't just about national pride, it's about gaining real power and building protection from the reach of US sanctions, which have been used as a tool of foreign policy. To achieve this, China is making it easier for foreign investors to buy yuan-denominated bonds and is actively encouraging global trade to be settled in yuan instead of dollars. Dim sum bonds, yuan bonds issued outside China, now let companies tap into global capital markets without ever touching the dollar, opening new doors for international finance. The more companies and countries use the yuan for trade and investment, the less central the dollar becomes to the world economy. This is a direct challenge to the dollar's long-standing supremacy and signals a major geopolitical shift that could alter alliances and economic strategies. The US has long enjoyed the privilege of borrowing cheaply and wielding powerful financial sanctions, thanks to the dollar's dominance. But as China's yuan-based system grows and gains acceptance, that foundation is slowly eroding, threatening to undermine America's financial leverage. We're witnessing the rise of a multipolar financial world, where influence is shared among several major currencies, not just one. The dollar is no longer the only game in town, and its rivals are gaining ground with every passing year. This quiet revolution in global finance could reshape the world's economic power structure for generations to come, affecting everything from trade to politics. The big question now is, how fast will the world make the switch? And what will it mean for everyday people and businesses? The answer could redefine the global economy, setting the stage for a new era in international finance. This shift isn't theoretical. China's biggest companies are already leading the way. Tencent, the tech giant behind WeChat, now raises billions in yuan, not dollars. BYD, the electric vehicle powerhouse, is funding its global expansion with yuan-based financing. Why? Borrowing in yuan is now often cheaper and more predictable than in dollars. As the Fed cuts rates and the dollar weakens, the math changes. When giants like Tencent and BYD succeed with yuan bonds, it proves the market's viability. More companies follow, deepening the yuan market and accelerating the trend. Each yuan bond issued is one less dollar bond, chipping away at dollar dominance. The euro-dollar system, which fueled globalization, is losing ground. As Chinese firms repatriate their financing, global demand for dollars drops. The world's financial plumbing is being rerouted in real time. The consequences are just beginning to unfold. Experts are sounding the alarm. Stephen Jen, former IMF economist, says the dollar thrives in boom or crisis. But right now, we're in a weak middle ground. The Fed's rate cuts signal a muddling US economy, weakening the dollar. Central banks are quietly diversifying away from the dollar into yuan and gold. It's not a sudden collapse, but a slow, grinding decline that's picking up speed. Scott Bessent, former Soros Fund CIO, warns that massive US debt and low rates are a toxic mix for the dollar. He draws parallels to past eras when dominant currencies lost their edge, often due to debt and shifting trade. With China now the world's top trading nation and creditor, the pillars of dollar dominance are eroding. The consensus: we're not facing an overnight crash, but a sustained period of dollar weakness with global consequences. The world is preparing for a new financial order. Are we? The Fed's independence is under siege, especially since Trump's presidency. Political pressure to keep rates low has blurred the line between economic stewardship and political gain. Investors once trusted the Fed to act responsibly. Now, that trust is fraying. When monetary policy looks politically driven, holding dollars becomes riskier. The current rate cuts are happening in this climate of interference. Political drama adds a new layer of vulnerability to the dollar. The world is watching and searching for alternatives. What's the worst-case scenario? Stagflation, stagnant growth, rising unemployment, and high inflation. A weak dollar makes imports, everything from TVs to sneakers, more expensive. Global commodities like oil and gas also spike, hitting your wallet at the pump and at home. The Fed is trapped to raise rates and risk recession, or keep them low and let inflation spiral. For families, it means stagnant wages, rising costs, and shrinking savings. Businesses face higher costs and weaker demand, leading to layoffs. This isn't theory, it's a real threat to millions of households. The weak dollar could trigger profound economic pain. The stakes are personal, not just political. The time to pay attention is now. The dollar has weathered downturns before, but this time, China is actively building an alternative. The last major dollar slump lasted over a decade. Slow, grinding, and marked by rising commodity prices. Now, China's challenge is bigger and more deliberate. Will more companies ditch the dollar for yuan? Will the Fed cut rates further, fueling the decline? Will countries accelerate their move away from dollar reserves? The future of the US economy is tied to its currency. A slow decline might be manageable. A rapid collapse could spark crisis. Are we seeing a temporary dip, or the end of the dollar's reign? Policymakers must prepare for a world where the dollar is no longer king. The answers will shape the global economy for years to come.